What's up, people? Welcome back to Invest with T-Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So it's been a pretty volatile week for the ChargePoint stock. After seeing a nice uptrend into the earning call, the stock dropped, then attempted to recover, only to be dragged down with the rest of the market, closing the week down 4.05% at $20.16. So for today, I'll go over an interview post-earning call with ChargePoint CEO Pascuale Romano and discuss their key takeaways from their Q3 performance, share the latest analysts' price targets, and wrap up with a portfolio performance review expressed in percentage gain or loss. As always, I'd recommend watching all the way through so you don't miss out on any pertinent information I'll be sharing. Drop the video an early like if you haven't already, and hit that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. Following the earning call, ChargePoint CEO Pascuale Romano was on CNBC discussing the results. Despite what I would consider to be a great quarter for ChargePoint, the stock tanked right after the earning. And no, that initial drop can be attributed to the broader market forces. So what happened? Well, let's take a listen.
Looking back over the stock performance, it really ran into the end of last year. And I wonder if this was just one of those show me years where, you kind of priced in a lot of the excitement and then you get a lot of good headlines this year, but investors are already looking for, maybe better bottom line results, for instance.
We've been guiding, pretty accurately on our top line. In fact, we're beating guidance on revenue. We've raised guidance for Q4, and we've set expectations that from an OpEx perspective, we're in investment mode. This is a massive market, and we're in investment mode, and we expect to glide slope to profitability in time. But we don't want to squander the lead we have in this market, so we're investing heavily to take share.
So I'm not sure if you caught that, but the reason the stock dropped is largely because ChargePoint missed on the bottom line, which represents the profitability metric. The market was expecting a loss of 13 cents per shares, but instead ChargePoint reported a loss of 14 cents per share. And so oftentimes it doesn't matter how well a company did overall in the eyes of Wall Street if they don't meet or exceed the expectations. For me, as an investor with a long-term mindset, what Pascuale touched on just now and during their earning call as well is what I actually care about. They've actually beat on the top line, with revenue coming in at 1.77 million above expectations for a total of 65.03 million for the quarter. For context, that's a 78.8% increase year over year. And if you think about it, they had raised guidance during their Q2 earnings for their revenue projections and still managed to beat that raised guidance. And now they've once again raised revenue guidance for Q4. So yes, they're spending more, but they're also bringing in a lot more. Ultimately, they're investing heavily now so they can grow the infrastructure network and be ready to support the surge in demand that will hit in the next few years as the EV transition accelerates in the US and in Europe.
You tell investors when to expect that inflection point so they can all get in at the right moment. When are the shares going to start to hear from you? Yeah, and obviously they want you to be in investment mode to kind of be in the lead in the long run, but when do you think the narrative is going to start to change?
I think when people start understanding how the industry actually works. Kelly, I think there's quite a bit of noise out there right now, and it's just going to take a while for investors to understand how to judge companies like ours.
That response is pretty funny, and that awkward pause, kind of priceless actually. But all joking aside, you can see that he's clearly focused on the future and maintaining the substantial lead they have over the competition. Yes, the stock price is down compared to a competitor like Blink Charging, but realize that as it stands, ChargePoint currently commands about 75% of the US market share. They are squarely focused on growth and achieving profitability no later than mid-decade. They are currently projecting to achieve revenue growth proportional to the EV adoption for a compound annual growth rate of 41% through 2026. That's impressive.
And what would you say, when we talk about you guys as an EV charging network, and obviously as the space gets more crowded, what differentiates you from others?
Well, first of all, we've been in this industry for 14 years, significant operations in 2 continents, operating in every vertical of EV charging that we can think of anyway. So breadth of product line, breadth of sales reach, breadth of channel, breadth of everything, ability to handle scale. All those things are things we think significantly differentiate us.
In my last video on ChargePoint, which I'll link here, I touched on their latest partnership with Sonova. The fact of the matter is, ChargePoint continues to expand their customer base in the commercial, fleet, and residential verticals. 76% of top 50 companies in the US are now part of their customer base, And even though this isn't a full extensive list, you can see how they have fully integrated their software app service with OEMs like Mercedes, Volvo, and GM, how they are bringing in convenience from a payment perspective, and overall simplifying the experience, making it easier for people and corporations alike to make the transition to EV. I personally use their service on a weekly basis and love it.
What's profitability likely to look like for the next couple of quarters?
Well, we're continuing to improve margins. Obviously, that's more of a challenge in a supply chain constrained environment because assurance of supply limits the velocity with which you can make changes in your supply chain. You can't have it both ways. Our margin performance as a result is a little behind where we expected in a non-supply chain constrained environment, but we're continuing to make margin improvement on top of having what the world would consider one of the worst supply chain environments that it's ever seen in recent history.
What's worth noting here is this. We already know that supply chain issues are lifting. Legacy auto and pure play EV makers like Tesla and NIO have plans to ramp up production and sell a significant amount more EVs next year. And so look at it this way. Despite all the supply chain issues and COVID variants we had to deal with this year, ChargePoint was able to increase fleet billing by 69% from last quarter. That represents a 200% year-over-year improvement. Residential billing grew 65% from last quarter, which represents a 50% year-over-year improvement. And they grew revenue in the European market 190% year-over-year, thanks to the focus, continued investment, and strong push they continue to make there. Man, running out of breath here. But if you... So I believe that it only gets better from here. I'm personally taking advantage of these lower prices while I can.
So let's close talking about the subscriptions that you are experiencing. You had some decent year-on-year growth there. I mean, is that going to be a really important part of, the company's strategy, and obviously to investors maybe the valuation and the multiple over time?
It is the company's strategy. Period. Full stop. We do not sell hardware without subscription to a cloud service associated with the services the customer wants to deploy in their parking lot. So we are a cloud service. We are a SaaS company through and through. We happen to have the delivery vehicle, which is a physical charger in the parking lot, but we are a SaaS company through and through.
That's a very important point often people don't realize. ChargePoint does not own any of the hardware you see around. They sell the chargers to the various businesses and fleet operators, which means that they generate revenue on the sale of the hardware, they generate revenue on the maintenance of the hardware, and they generate revenue on a software subscription required to operate that hardware. Once they complete the expansion and achieve true economies of scale, their profit margin will go through the roof. So bringing it back full circle, if Wall Street and near-term minded traders want to dump the stock because of a narrow miss on the bottom line, well, that's good with me, right? I'm thankful for the opportunity to add more at a lower price as it is. Ultimately, what you need to realize is that this is a stock that has a decade plus of growth ahead of it as we complete the transition to the electric future of transportation. All right, so how did analyst ratings shake out post-earnings call? Well, let's run through that. First up, we have Stephen Gengaro, who maintained his buy rating with a $29 price target. The main reason being that he sees the revenue from the subscription model continue to rise for the foreseeable future. Next up, we have James West, who also maintained a buy rating with a $34 price target. He says, and I quote, "We continue to believe that the company is viewed as an index for charging, and investors look to it first for exposure to the sector given its scale, transatlantic reach, and role as the arms dealer for the industry." And he also adds, as an EV infrastructure designer and manufacturer, ChargePoint is agnostic to where its equipment is installed with the desire to sell the hardware and become the software provider. Therefore, investors do not have to determine exactly how this mega theme of electric mobility unfolds, end of quote. David Kelly from Jefferies also maintained his buy rating with a $34 price target, citing very much the same as the others. He also adds that the passing of the US infrastructure bill and the pending EV credits points to the ramping of EV sales and charging momentum. Overall, ChargePoint has 9 ratings, 5 buys and 4 holds. Price targets range from $35 on the high end to $24 on the low end. The bottom line here is this: everyone realizes that this company and the stock has nothing but upside from here. It's been a slower year as revenue caught up to the valuation, but that said, next year I'm expecting the stock to start running again. Well then, let's wrap it up with how the portfolio did this week. At the lowest point, I was down by 4.43%, then went on a roller coaster ride, climbing all the way up to 8.73% at the highest point. Before plunging back down, I'm now on a steady climb up with an overall gain of 1.04% for the week. As we head into next week, what you really want to be paying attention to is the minutes from the Fed FOMC meeting. Once we have clarity on the path forward and the speed of the tapering, I expect upward momentum to resume market-wide. One look at the three major indices and you'll notice that we pretty much made our way back to near all-time highs already. Now, even though I'm not a financial advisor, I'm willing to bet that once we get the clarity on the pace of the tapering, markets will rally into year-end. And on that note, I'll leave it here for today. Don't forget to drop the video a like if you enjoyed the content and share with others who you think could benefit from it. For my newcomers, subscribe and don't forget to ring the notification bell so that you don't miss out on any future content just like this. As a reminder, I post every Sunday and now target at least one in-week video for more crypto-focused content. Thank you for watching, stay humble, hustle hard, and I'll see you in the next one.